The LBMA stress gauge just flashed the kind of warning that shows up before the market admits something is wrong, and the timing is not an accident. Price can scream record highs, while the plumbing underneath whispers settlement friction. And right now, that whisper is getting louder than the headlines. The force trying to suppress this move isn't a villain in a hoodie. It's something far more powerful. And boring. Balance sheet limits, dealer risk limits, and the mechanics of a market that's built on confidence and smooth delivery. And the hidden mechanism most people are missing is this. You can have plenty of metal in the system and still have a shortage of the only kind that matters during stress. Immediately deliverable, lendable float that someone is willing to part with at a normal rate. If that float tightens into year-end, the breakdowns don't start with a crash. They start with spreads, borrow costs, and the sudden disappearance of easy liquidity. By the end of this, you'll have a concrete next week checklist, the levels that actually matter, and the one thing that would break this whole setup if it happens. Because if that one level fails, the math changes. Start with the tape, because it sets the stage. Late December 2025 isn't just bullish metals, it's extreme metals. Gold pressing into the mid $4.5 per ounce, and silver ripping through $75 with prints up in the high 70s. The kind of move that turns normal hedging into forced hedging and normal skepticism into, I need to know what's real. That's the emotional surface. But the signal isn't the price itself. The signal is the stress indicator spiking, meaning the market is paying a rising penalty for immediacy. And that penalty shows up in places most people never look. The bid offer, spread on spot, the bid offer spread on forwards, the kink in the short end of the curve, and the dislocations between New York futures and London spot that widen when arbitrage is theoretically obvious but practically constrained. Everyone can see a candlestick. Almost nobody watches whether dealers are quoting tight markets or wide markets, whether borrow terms are calm or frantic, or whether the paper-to-physical bridge is functioning smoothly. And that's where the real pressure starts. Here's the crucial translation. An LBMA-style stress read is not a prophecy about direction tomorrow morning. It's a diagnosis about liquidity today. It's telling you how hard it is to move size without moving price, how expensive it is to borrow metal for delivery windows, how reluctant holders are to lend, and how constrained market makers are in turning paper exposure into physical settlement. When that tightens, the market becomes jumpy. Not just volatile, jumpy. Because jumpiness is what happens when the marginal liquidity provider steps back. And when the marginal liquidity provider steps back into year-end, you get gaps, you get whipsaws, and you get those sudden, how did we move that far on that little news? Moments that break weak hands even when the trend is correct. But that's not the part that matters. The part that matters is why this happens before breakdowns. In the London bullion world, price is not a single centralized exchange print. It's an OTC ecosystem built on relationships, credit lines, unallocated balances, and a promise that conversion and settlement can happen at scale. Most participants aren't sliding bars across a table, they're moving claims. Unallocated is the bloodstream of liquidity, fast, flexible, and cheap, until it isn't. Stress is what you see when the bloodstream thickens. Because if the appetite to lend falls, or the cost to borrow rises, or the willingness to intermediate shrinks, then everyone who relies on smooth conversion suddenly faces friction. And friction is what turns a normal market into a market that snaps. The hidden detail lands here. Headline inventory is not the same thing as usable float. London vault totals can be huge, and they are thousands of tons of gold and tens of thousands of tons of silver stored across the network. Yet the amount that is actually free to move, free to lend, and free to deliver on short notice can be far smaller than the headline number suggests. Metal can be allocated to long-term holders who don't lend. It can be encumbered as collateral. It can be sitting in the wrong form factor or location relative to what's needed for a specific delivery mechanism. And even when it is technically available, the holder might demand a premium that effectively removes it from the liquidity pool. This is why stress can spike without an obvious shortage headline. It's not, there's no metal. It's the metal that matters at the margin is becoming expensive, sticky, and hard to source. Well, and once you understand that, you stop staring at price alone, and you start tracking what forces participants to do next. So let's explain the mechanism cleanly, because it's the engine room. Think of leasing and forward pricing as the cost of time and the cost of access. In a healthy market, if you need metal now, you can borrow it at a relatively stable rate, sell it, hedge it, fabricate it, deliver it, and the forward curve reflects normal carrying costs. In an unhealthy market, the demand to borrow surges or the supply of lenders shrinks, and suddenly the price of borrowing jumps. That matters because bullion banks and dealers are the shock absorbers. They borrow metal, lend metal, swap exposures, warehouse risk, and smooth settlement. When borrow costs jump, their shock absorber stiffens. They quote wider. They reduce size, they demand better terms, and that ripples outward fast. Because if you're a fabricator or industrial user and you can't borrow metal cheaply, you either pay up in the spot market, or you delay, or you scramble for alternate supply. If you're a dealer facilitating hedges, you suddenly have to charge more for immediacy. If you're a fund running a basis trade, your carry math changes. If you're short paper exposure that you assumed you could roll smoothly, your margin and funding risk rises. And if you're a market maker sitting on large derivative books into year end, you don't take chances on thin liquidity, you cut risk, you step back. And that is how stress becomes a breakdown. Because in breakdowns, it's never the average participant that matters. It's the marginal participant, the one who normally provides liquidity and suddenly can't. The next detail flips the whole setup. The paper market and the physical market can diverge without any crime required, purely due to constraints. Futures are beautiful because they're standardized and centrally cleared. London Spot is powerful because it's deep and flexible, but the bridge between them, moving exposure across time, venue, and delivery expectations, depends on capacity. Refining capacity, transport capacity, credit capacity, balance sheet capacity. And that bridge is most fragile at the exact moments people least expect. Periods of holiday thin liquidity, end of month, end of quarter, and especially end of year. Because year end is when dealers care about window dressing, capital charges, and risk-weighted assets. The calendar isn't a footnote. The calendar is a catalyst. This week, the market isn't just trading a view, it's trading through constraints, which is why stress indicators love to spike into these windows. That's why now matters more than why ever. If you want to see the proof stack, you don't look for one smoking gun. You look for 5 to 6 consistent signals that all rhyme. Here are the signals that typically show up when London plumbing tightens, and you can see versions of them showing up again now. First, spot price bid-offer spreads, and forward bid-offer spreads tend to widen when liquidity is under strain. That's not a theory. It's how markets behave when market makers protect themselves. When spreads widen, you're paying a bigger toll to transact. Second, the short end of the curve starts to act weird, either flattening, kinking, or showing signs of immediate tightness, because the market is pricing immediacy differently than it priced it a month ago. Third, dislocations between venues become louder. When New York futures lead and London spot lags, or vice versa, or when the cost to swap between them rises, that's the market telling you that arbitrage is constrained. Fourth, you get street symptoms. Larger premiums in certain channels, reduced willingness to quote size, longer lead times, and a noticeable change in language. Traders don't say no problem anymore, they say let me check. Fifth, you get flow tells. Institutions that don't care about your entry price keep accumulating, and their buying turns structural tightness into mechanical tightness. And sixth, the chart itself starts to show breakout behavior that forces hedgers to adjust, because when price pushes into round number strikes, dealers hedging can amplify moves. That's a lot of layers, and that's the point. One layer can be noise. 6 layers is a regime. And that's not the part that matters. The part that matters is what this forces participants to do next week. Before we go there, anchor the reality of inventories, because this is where skeptics rightfully push back. London Vault totals are large, and recent published data shows big numbers. Gold in the thousands of tons and silver in the tens of thousands of tons at the end of the most recently reported month. That does not contradict stress. In fact, it explains it. Because those numbers include metal held in commercial vaults and, for gold, also central bank-related holdings that are not necessarily part of the available float for market making. Even within commercial vaults, a lot of metal is simply not for sale or not for lease at any price that makes the market calm. The stress signal is not we ran out. The stress signal is the marginal unit is getting expensive. The marginal unit is the one that sets the price during stress. And that's why big vault numbers can coexist with tightness. It's also why a quiet shift in behavior can turn loud. Imagine 2 worlds. In world A, there's plenty of lendable metal. Borrow costs are stable and dealers are comfortable intermediating. In world B, the lendable pool shrinks because holders decide they want less counterparty exposure into year end, or they want higher compensation, or they are using metal as collateral elsewhere. Vault totals barely change, but lendability changes dramatically. Price might not move much on day one, but spreads do. Borrow terms do. Settlement convenience does. The stress indicator spikes, and then the breakdown risk rises, because once friction appears, it tends to compound. People who sense friction try to secure metal earlier. That increases immediate demand. That tightens lendability further. That pushes borrowing costs higher. That leads dealers to widen spreads more. And then you get reflexivity. The act of hedging and securing supply creates the shortage-like conditions that justify the stress. That's the loop. And that's why these indicators matter before breakdowns. Now, zoom into the NY versus London dislocation, because it's one of the cleanest ways to see stress without romance. In normal times, if there's a meaningful price gap between New York futures and London spot, sophisticated players arbitrage it. They sell the rich side, buy the cheap side, deliver, swap, finance, and the gap narrows. The existence of big, persistent gaps is not a free money sign, it's a constraint sign. It tells you that the theoretical trade is bottlenecked by something practical: financing costs, credit lines, inventory availability in the right place, logistics, or balance sheet capacity. And year-end is when those constraints bind hardest. That SY spreads in exchange for physical style measures become the truth teller when price itself is noisy. The price can be lying in the sense that it looks clean and continuous, while the spread is screaming that the system is strained. Because if the spread is wide, the system is charging a toll for conversion, and that toll is the stress. The next detail is what flips the whole setup: options. You don't need to be an options nerd to understand the effect. When price accelerates into round numbers, gold into big psychologically important figures, and silver into those headline-grabbing thresholds, there are often large open interest clusters. Dealers who sold options hedge dynamically. In some regimes, that hedging dampens moves. In others, it amplifies them. If the market is near key strikes, and the dealer community is positioned in a way that requires them to buy more as price rises, you get reflexive buying, gamma effects that can turn a grind into a sprint. And when liquidity is thin, a sprint becomes a gap. That doesn't mean guaranteed squeeze. It means the path of least resistance can become unstable. This is why breakdowns in stressed markets are not always down. A breakdown in market structure can be up. It can be a violent repricing, a jump to a new level, a repricing of scarcity and immediacy. The breakdown is the system saying your old assumptions about smooth liquidity are no longer valid. Now, layer in the macro driver stack, because no serious metals viewer wants a story that ignores rates and currencies. Metals respond to real yields, currency confidence, and liquidity conditions. The problem is, people treat that like a simple on-off switch. Rates down, gold up. Reality is messier. In a world where policy is expected to ease and fiscal pressures are high, gold can rally because it's the anti-credibility asset. Silver can rally because it's both an anti-credibility asset and an industrial input. But during stress, funding conditions can tighten even as the market expects future cuts, creating a weird mix. Risk assets can wobble, the dollar can lurch, and metals can become both a haven and a source of liquidity. This is why you get violent whipsaws even when the long-term thesis is intact. The market can force liquidation. It can force profit-taking. It can force sell what you can. And then, when the dust settles, the structural bid reappears. You can be right and still get chopped. That's the psychological trap. And that's exactly how volatility is used against retail. Here's the viewer psychology shield, because if you don't internalize this, stress will eat you alive. In markets like this, volatility's job is to separate you from your plan. It does it in 3 moves. First, it gives you a clean breakout that triggers fear of missing out. You chase. Second, it slaps you with a sharp pullback that feels like betrayal. You panic. Third, it rips again without you, and you either revenge trade or you swear off the asset right before the next leg. The manipulation isn't a person, it's the structure. Thin liquidity plus leveraged positioning plus headline-driven sentiment creates a machine that harvests emotional mistakes. Your defense is simple, but not easy. You must distinguish a trend signal from noise. Noise is intraday spikes, headline whips, and wickouts during thin sessions. Trend signal is structure, higher lows and pullbacks, buyers showing up at prior breakout zones, stress indicators staying elevated rather than instantly normalizing, and the market refusing to give back the move despite scary narratives. If the thesis is plumbing stress is rising, then the confirmation is not a green candle. The confirmation is that the market continues to price immediacy as valuable. If the market goes quiet and spreads collapse back to normal, that's the thesis weakening. If the market remains jumpy and conversion remains costly, the thesis stays alive even through pullbacks. Because if this one level breaks, the math changes. Now let's get concrete without pretending we can predict the future. Think in 2 scenarios, because both can be bullish and both can hurt you if you trade the wrong tempo. Scenario 1 is the controlled pullback and retest. In this scenario, price cools, late longs get shaken, and the market tests the breakout zone. Gold might pull back into the low to mid 4400s after flirting with the mid 4500s, and silver might revisit the low 70s after making noise above 75. The key is not the exact number, it's the behavior at the zone. Do buyers defend it quickly? Do dips get absorbed? Do spreads and stress remain elevated, implying tightness persists even as price consolidates? If yes, the retest becomes a launchpad. That's the calm, bullish scenario. Scenario 2 is the continuation squeeze with gap risk. In this scenario, the market doesn't give clean pullbacks. Liquidity thins further into the year-end window. Options-related hedging amplifies the move, and anyone who is structurally short or underhedged is forced to pay up. You get air pockets upward, you get headlines after the move, not before, and you get the most dangerous thing in markets, the feeling that it can only go one way, right before it whips the other way. In the squeeze scenario, you respect that even if the direction is up, the path is violent. Your job is not to win every tick. Your job is to avoid emotional liquidation. Now let's talk about levels that matter, but in the only way that's honest, as behavior zones and risk triggers, not magic lines. For gold, the market has been orbiting a psychologically important region in the mid-4500s. When price is that extended and that visible, the real level is often the prior breakout shelf beneath it, the zone where the last wave of sellers got absorbed and the new wave of buyers proved they were real. If gold can hold the broader breakout area on pullbacks and then reclaim the highs with momentum, that's a strong signal. If it loses that shelf and closes decisively below it during a week where stress indicators normalize, that's a warning that the move was more positioning than plumbing. For silver, the $75 area is a headline magnet, but the more meaningful behavior is whether the market can hold above the most recent consolidation band in the low 70s after these explosive prints in the high 70s. Silver is famous for brutality. It can drop 10% and still be bullish. It can rise 10% and still be a trap. So your invalidation concept must be structural. If silver fails to hold the breakout structure and starts putting in lower highs with rapid stress normalization, that's the market telling you the squeeze energy is cooling. If silver holds higher lows, despite violent intraday noise, the trend signal remains. And that's where the real pressure starts, because the market will try to confuse you with drama while the structure quietly tells the truth. Now stack the institutional and industrial layer, because this is where the why now becomes more than a calendar story. Silver has a structural supply challenge because a large share of global production comes as a byproduct of other metals. That means supply doesn't respond quickly to price. You can't flip a switch and mine more silver next month. If industrial demand accelerates, solar, electronics, electrification, data infrastructure, then tightness can persist even if price is high. On the institutional side, gold AS bid has been supported by long horizon buyers who treat it as reserve diversification and as an insurance asset, not a trade. Those flows don't chase pennies, they absorb supply over time. When both of those realities meet a year-end liquidity window, stress indicators matter more, not less. Because the market is trying to process structural demand through a temporarily constrained plumbing system, that's when dislocations show up, that's when bid-offer spreads widen, that's when the cost of immediacy jumps. And that's when breakdowns happen. Not because the world ends, but because the system reprices the cost of certainty. Here's the counterpoint, because trust requires it. Not every stress spike becomes a crisis. Sometimes stress spikes because dealers step back temporarily. Sometimes it's seasonal. Sometimes it's just a positioning wave that strains liquidity for a few sessions and then fades. Sometimes high prices themselves cure tightness by pulling out marginal sellers. And sometimes the market punishes the most crowded narrative right when everyone agrees. If everyone believes breakdown is inevitable, the market can do the cruelest thing. It can calm down, drift sideways, and bleed impatience until the stress gauge normalizes and the crowd loses interest. That's a real risk. Another risk is forced liquidation from outside the metals complex. If broader markets seize and funds need liquidity, they can sell metals to raise cash even if the long-term thesis is intact. That's why you don't marry a position. You marry a process. You respect that price can whip around violently even if you're right. And you build your behavior around what would invalidate the thesis, not around what would flatter your ego. So what comes next, specifically in the next week or two? You watch the plumbing and the behavior, not the commentary. Watch whether liquidity stays thin. Watch whether spreads stay wide or snap back. Watch whether the short-dated structure continues to signal tightness, meaning the market keeps charging a premium for immediacy rather than easing back to business as usual. Watch for signs that the NY London bridge is strained, persistent venue dislocations, stubborn conversion costs, and repeated episodes where the market gaps more than it should on routine news. Watch the reaction to pullbacks. Do buyers appear quickly in the prior breakout zones? Or does price sag and then accelerate lower with no support? Watch the weekly close, not the intraday noise, because if this one level breaks, the math changes. If the market loses its breakout structure and the stress gauge collapses back to normal, that's the signal that the stress narrative was more transient than structural. If the market holds structure and stress remains elevated, that's the signal that the system is still under strain and the next repricing risk remains. Now, let us turn that into a simple checklist you can actually use without getting hypnotized by every tick. First checklist item, does the market keep paying up for immediacy? In plain terms, are the transactional frictions still there? If yes, the stress is real. Second, does price respect prior breakout zones on pullbacks? If yes, trend signal is intact. Third, do options-related magnets accelerate moves into round numbers and then hold those gains, or do they reverse hard? Holding gains suggests forced buying and structural demand. Hard reversals suggest positioning games and thin liquidity traps. Fourth, do you see confirmation across metals, not just one? Gold and silver don't always move together, but if both are acting stressed and both are holding structure, it's harder to dismiss. Fifth, do macro narratives align with the tape? If real yields are easing, currency confidence is shaky, and geopolitical uncertainty stays elevated, the structural bid is more credible. If macro suddenly turns risk on with rising real yields and tightening liquidity, metals can still hold, but the path becomes more violent. That's your roadmap. 2 scenarios, 1 checklist, and 1 invalidation concept. And here's the quiet warning you need to hear. If you try to trade this like a calm market, you will be emotionally manipulated. The market will bait you with clean moves and punish you with ugly ones. It will make you feel late right before it pulls back, and it will make you feel wrong right before it rips. Your edge is not speed, your edge is composure. Decide what you're actually doing, short-term trading, medium-term positioning, or long-term insurance, and don't let a 90-minute spike change your identity. If you're a medium-term macro watcher, you should care more about whether stress persists and structure holds into the turn of the year than about whether tomorrow is green or red. If you're a short-term trader, you should care more about liquidity conditions and to where forced flows might hit than about opinions. Either way, your job is the same, separate signal from noise. And that's not the part that matters. The part that matters is that the LBMA stress spike is telling you the market is not just moving, it's straining. Strain is not automatically collapse, but strain is when the probability of abrupt repricing rises. In calm markets, price discovery is smooth. In strained markets, price discovery is lumpy. Lumpy means gaps. Lumpy means slippage. Lumpy means I didn't get the fill I expected. And lumpy means the headlines will always arrive late. So if you want to be early, you watch the plumbing. That is the entire thesis in one line. The plumbing is tightening into a calendar window where liquidity naturally thins, while prices are already extended and options dynamics can amplify moves. That combination is exactly when breakdowns, upward repricings, violent squeezes, or sharp shakeouts tend to appear, not guaranteed, but structurally plausible. Now, if you want a clean way to think about targets without pretending we know the future, think in zones and in tempo. In the controlled retest scenario, you expect price to respect breakout shelves and then make a higher high after consolidation. In the squeeze scenario, you expect price to overshoot, gap, and then eventually mean revert violently before resuming. Your target in a squeeze is often not a number, it's a behavior. A blow-off impulse followed by a sharp, fast retrace that tests whether the new level is real. That's how these markets digest stress. And the invalidation is equally behavioral, a loss of structure combined with a clear normalization of stress indicators. If the market goes back to tight spreads, easy conversion, and calm borrowing terms, then the stress before breakdown story has cooled, at least for now. If it doesn't, the system is still charging a toll, and tolls tend to rise further before they fall. Here's the final revelation, the one metric everyone must watch, even if they ignore everything else. Watch the cost of immediacy. Call it spread, call it friction, call it borrow tightness, call it dislocation, whatever your preferred language is. Because price can be a performance. Immediacy cost is the backstage. The backstage is where breakdowns are born. If you're seeing that cost spike while the tape is already hot, you're seeing the market's internal stress accumulate. That doesn't mean sell everything or buy everything. See, it means respect the regime. It means size like volatility is real. It means don't let a wick convince you your thesis is dead. It means don't let a breakout convince you risk is gone. And it means you operate like a professional. You define what would change your mind. You watch for it. And you don't panic until the market actually breaks your framework. If you are the kind of investor who rather be early with the mechanics than late with the headlines, stay close to this checklist, share what you're seeing in your own market, premiums, liquidity, weird quotes, anything that feels off. Because in stressed regimes, the crowd sees the move, but the community sees the plumbing. And if the LBMA stress spike is right, the next week or two won't be about who has the loudest take. It'll be about who understands what the market is being forced to do.